Welcome to today's episode of Beyond the First Million. I'm your host, Gideon and Drucker, alongside my much taller mustache, my much taller colleague, Jordan Haynes.
My much taller mustache.
I like the idea that as we keep emphasizing the mustache every week, people might start only watching, like, does Jordan have the mustache? Yeah, okay, on to the next week. And they're going to know at what point you decided to end. And that's going to build up in energy and momentum.
Be a big deal.
It's tough to transition mustache equity planning, but that is what we are doing. We are talking about stock options equity compensation. Last week, we spoke about the mechanics, the tax impact, when to exercise, when to hold, heck, what stock options and the different types of stock options are. And it's all super important. And we needed to start there. We need some foundation. Otherwise, we can just keep throwing out the word stock options, equity compensation, and when it would start to not mean anything if you don't have that underpinning. But I think today's episode is, quite frankly, even more important to the long-term understanding of how to use stock options. I think too many advisors, CPAs, clients, just individuals in general, they get so wrapped in the tax mechanics. They're so, all right, well, I need to understand what's the tax impact if I do this or that. And they get so kind of wrapped up in tax land that they forget the point of stock options. The reason you work at companies that provide equity, when I say equity, whether that's options, whether it's compensation, is you get to ultimately share in the profits of the company. You get to build your net worth, have huge upside potentially into growing your wealth and taking those options, that compensation, and turning it into real wealth for your family. How do we think about your equity compensation as part of building out your financial plan? How much do you want to hold in company stock? How much do we want to immediately sell because you have enough money just from that to actually accomplish your financial goals, to do everything that you set out to at the outset?
Last episode, we spent a lot of time talking about what stock options were, how to think about them, the principles as it relates to actually exercising or selling them, all very important. But almost what needs to happen first is having a strategy, having a plan in place. And that's what we're going to talk about.
Knowing how much money you need, what that money is designed to accomplish. We don't want a potential outcome where you save $3 in taxes, but miss out on $6, whether from a diversification standpoint, from a cash flow decision. And that's what today's episode, it's zooming out and helping you see the big picture when it comes to your stock options. So let's dive into it. The entire reason your clients are working so hard to have the opportunity to vest and exercise their stock options is to use this potentially life-changing amount of money to further become financial independent and reach their goals. This money, like any money, but these stock options is a tool. How do you turn this hypothetical, because at this point, if we're talking a pre-IPO company, meaning there's no liquidity attached to those stock options, how do you turn this hypothetical money into wealth that cannot be taken away from you, into wealth that actually can be translated into money that you use for whatever it is you want to use money for? So the framework that we start here is asking 3 questions. We start with, what are your financial goals and priorities as you think about the next 30 years? Literally, let's model out, let's label, what are the goals and priorities? What are you trying to use money for? Are you trying to buy a home? Do you want to take a sabbatical? Do you want to leave big tech in 5 years? Do you want to be work-life optional by 55? Do you want your spouse to not have to work? Or maybe your spouse wants to start their own business. What are the financial goals and priorities we're saving towards? Then it's, all right, well, how much money will it take to reach those goals? What is your number? And again, not, well, I need $5 million. No, how much money do you need to hit each individual goal that we're planning for? And then how many of these goals can already be funded without any of these company stock or these options that can turn into wealth? Meaning, based on your existing assets, income, your ability to save, how on track are you already to accomplishing everything you set out to? From that point, we follow that funnel. We arrive at a decision tree when it comes to your equity that says, all right, great. We want to now sell enough company stock, whether today or in the future, but we know the goal is to sell enough company stock to fully fund your life goals, regardless of what happens in the company. Company can go up, company can go down, but if we can take enough money out of your options to fund everything you want to achieve in life, congrats, you've won the game.
You need to figure out where you're going, number 1. Number 2, what's it going to take to get there? And then number 3, what do you already have that's going to help you do that?
Which is really, what's the delta?
Yes, yeah.
How much money do you need to bridge that gap? And we want to take the equity and at least sell enough to make that happen. But then we want to hold on to your company stock to the extent that you don't need this money to reach your level of financial independence. The company stock can become the icing on the cake. It could be the thing that takes you from 5 or 10 million plus, but it's not the money that you need to accomplish the things you're already focused on.
So in most cases, when you're talking to clients about stock options, do you want them to have the mindset of this equity compensation is additional beyond your normal saving into accounts, building things like that. Is that kind of how you're framing it with them?
Sometimes. I think equity compensation and being offered incentive stock options, non-qualified, is part of your compensation, right? It's part of the attraction at working at these companies. The idea is, hey, I want to build up enough stock options that I can exercise, have them in my pocket, and I can move on. They are absolutely a part of the financial plan. What we're saying here is we want to think about how do we turn that into enough money to hit our goals? And then if we want to hold additional equity in our company, it's getting us beyond what we need because we've already satisfied our initial goals. If somebody's working at one of these companies, I could hold on to all of it and I could have $20 million, or shit hits the fan and it goes a different direction, which is, by the way, what happens to most companies that have ever existed or not public. Or I could use some of this money to build 5 million and anything extra is extra, but I've already taken care of my family. I'm already in a good shape. The key word here is to consider holding on to your company stock. We are certainly not going to be the ones advising someone to hold more concentrated stock in their company simply because they can. Right? That is based on everybody's individual capacity, their desire for risk. Our job is to help clients understand how much money do they need to take out of that company stock to support their goals. And then we can have a conversation of, all right, here's what's left. How do we want to use that? Are you comfortable taking more, taking less? I want to frame this in a few individual examples. Let's say you're 45 years old, you're married with 3 kids, and you have 1.5 million in the bank in investments. That's your investable net worth, let's say, not including your primary home. And you have stock options worth, at this point, $5 million. With this fact pattern, we might consider selling most of that because that potential upside is significantly greater than what you already have, that alone can be life-changing money for you. That level of money that you exercise accomplishes everything you set out to, and it materially changes you from one level of wealth to the next. To get out of the 1.5, 3 kids, expensive area, you're doing well, but you could use some wiggle room. You could use some breathing room. Taking that $5 million and redeploying into a combination of cash for short-term needs and what you and your family have been talking about, and then diverting those stock options, that concentrated positions, into diversified equity investments. So in a portfolio that owns the entire market, outpace inflation without having so much single stock risk. That money is still invested. It's still meant to grow, but you have a little bit more understanding of what it can do for you long-term. You're not taking as much risk. And if doing those two things, turning that stock option, that equity on the other side of the pre-IPO, you can be like, cool, now we can accomplish all of our short-term goals. And we are now allocating money that is on track to hit our long-term goals. And it totally changes our life by doing that. Yes, that is a great way of thinking about your stock options, of using that money to advance your life mission.
I often find myself talking with new clients or people that start a new relationship with an advisor, maybe someone that hasn't had one before. And when we talk about investments, what I find is they often segment in their mind all their different accounts or different things that they have. One of those being their stock options or their restricted stock units. When I do that, what I often find myself talking to them about is, hey, what we want to do is bring all of these under one strategy. Like, you are working toward something specific. That's what we're working towards. And we want all of your accounts to reflect that thing. And I think what you're describing here is, in a lot of situations, those stock options, the equity compensation, could fund a lot of that.
While it might be nice to see if that $5 million can turn into $20 million, your financial plan is dependent on you having that $5 million itself. Having that $5 million, which by that we mean selling, diversifying, turn it into investments that have a historical track record, which no single company could possibly have a historical track record if they just IPO'd. So we don't know what's going to happen. That's where your risk capacity really comes into play. On the other hand, we've worked with clients that, when we started working with them, it was already their 3rd time working at a pre-IPO company, where they are in their early 30s. They have material net worth. They've been on the other side of those things going well, and now they're at it again with another company. So we can say, hey, they can take a little bit more risk. They don't have to think so immediately about those stock options translating to accomplishing their financial goals, because they have enough money today to accomplish all of their financial goals. In other words, they can take a bigger swing. They're still on track to accomplish everything they want. Whereas the first person, if they kept it all in their company stock and it didn't work out, that would be devastating, because now they have to essentially start over in building wealth, because it was a material part of their wealth building plan.
Yeah. There are some fundamental risks inherent in having just one stock. You need to understand what your risk capacity, how much risk you can actually take to make sure that you can still achieve the goals that you have.
Risk tolerance is just how you wake up thinking about how you feel about investing if money goes up, if the markets go up, if markets go down. And it's typically not tied to anything that matters. Risk capacity is more what we just defined in those two examples, which is how much risk can your financial plan actually support before all hell breaks loose, where you can take on a little bit more risk because you already have a plan that works for you. To your point about the single company stock versus diversifying, we're still not saying, oh, you should hold your stock in this one company. And typically that's a conversation with clients, how bullish they are, how optimistic, how much they enjoy having that sense of ownership in their company. But you are in a better position to hold that equity if it 10x's and leads to significantly more wealth, if you don't need that wealth to change your life tomorrow or next week. Before we move on, we should probably spend a second reminding you of the investment principle, which is that it is safer and you are more likely to end up with the wealth you need to accomplish your goals by taking a single company position and diversifying it into a 3,000 company position. Having a meaningful amount of your wealth invested in one stock is it's incredibly risky. Most companies go out of business. They don't do anything. They literally don't exist anymore. A lot of companies don't keep up with inflation, or you'd be better off just investing in the treasury. Very few companies actually earn money in a way that materially outpaces inflation. The idea that you are going to be working at or investing in one of the 4% over the last 100 years is astronomically small. Your company may be the unicorn of today, but nothing is guaranteed. And over a long enough time period, 30, 40 years, which is the only time period we care about when we're investing. If you go look at the top 10 holdings of the S&P 500 back 30 years ago, 1996, and you look at it today in 2026, there's only one company of overlap. Everybody that worked at those companies in 1996 or invested significantly in them thought those companies were the unicorns that were going to run the world and dominate forever and ever. Things change. We have an entire ecosystem around AI. The idea of that didn't even exist. So the point is, regardless of what company you work at, owning one single company stock, the math historically isn't on your side. Now, there are always counterexamples that prove the point. We actually just started working with somebody at NVIDIA. Been there 20 plus years. That worked out really well for them, right? That they worked there, they kept stock. So it's not that it can't work. Again, like the point is that you're more likely to end on the extremes because there are a lot of companies that haven't been Apple or NVIDIA. And if you kept investing, you kept your company stock where it makes up 70% of your net worth and it goes down and never comes back, you would have lost so much of your net worth that you can't come back from. And if the stock market historically has earned 7% above inflation, which is the historical rate of return over the last 100 years, if we know that investing in a broad, diversified portfolio of equities, of companies, can provide 7% above inflation, why are we taking the risk of earning more money that we don't need to actually accomplish our goals, where we could lose all of it, where now we're taking 10 steps back and we're shit out of luck? And that's how we think about this conversation around your equity, is how do we use this money to accomplish your goals? How do we be diversified to protect against the worst 15% of the outcomes that could realistically happen? And then we can start planning for upside on top of that. But it's brick by brick.
One of the fundamentals of building an investment program or an investment strategy for yourself, start with knowing where you're trying to get to, and then start to draft that program. And part of that strategy is having a diversified investment portfolio for the reasons that you just described. Some of the best investors in the world don't know what these quote unquote winners are going to be, these few companies that are actually going to drive most of the market improvements. The one thing that we know for sure is what's happened. The one thing we absolutely do not know for sure is what's going to happen in the future. And so because of that, to draft and create an investment strategy that's effective for you, helping you accomplish your goals, it needs to be diversified. I often ask a question to clients who have a significant amount of their wealth building from stock options is, if what you're receiving from your company was cash, what would you do with that? And they say, well, I'd save it and then we'd invest in a globally diversified portfolio. And it's the same principle here.
So you wouldn't take your $300,000 bonus and put the entire thing in Apple.
Back in, yes.
You wouldn't even do that even with Apple, which is obviously done phenomenal for a long time. Now, you might be listening saying, hey, isn't this episode about stock options and equity compensation? And you've barely used the word tax. This, I think, is the biggest mistake of focusing on the tax impact of your decisions instead of, no, this is fundamentally a cash flow and investment decision that you then want to make the most tax optimal way of going about accomplishing those. Company goes down 50%. And you now have 50% less money as a result. I promise you're not going to care that you've saved money on taxes in the first year after you held it. So it's not that the taxes don't matter, but this is fundamentally a conversation about how do you use your stock options, your equity compensation, your RSUs to further your life goal. And then we will do so in the most tax efficient way. Now we have our framework for how much stock we ultimately want to sell, which is really simple, enough to fund your life goals without having to be dependent on a single company stock. How much we want to keep, which is then ipso facto, the amount you don't need to fund your goals, but that might provide more upside, that ridiculous return, that thing that catapults you to the next level. That's the framework. How much to keep, how much to sell. And that's what we have for you today. We appreciate you being with us. If you enjoyed the episode, like, subscribe. If you have questions, and these might be 2 episodes that you might have a few questions because we got a little bit more technical throughout. We're going to keep doing equity compensation, stock option episodes, so we can use those questions to start the next round. So with that, thanks for being here. We'll catch you next week.